The biggest threat to your retirement isn't a market crash, bad investments, or even inflation. It's something far more ordinary and far more dangerous because it actually looks like safety. That's cash. I've seen many successful professionals earning over $500,000 a year unwittingly, completely train wreck their future retirement plans, simply because they're trusted in cash to protect them. And by the time they really realized about this mistake, it was much too late to fix it. In this video today, I'm going to walk you through what this hidden risk really is, why many investors don't spot it until the damage has already been done, and what truly smart investors are doing differently to protect the lifestyle that they've been working so hard to build. So, what's the risk that I'm talking about? Well, that's just the cash sitting idly in your bank and savings account. This cash in term deposits can feel safe because it doesn't move up and down like the stock market. But for high earners planning for retirement, that so-called safety is often the very most dangerous decision they can make. And in this video, I'm going to show you exactly why. So let's start by zooming out and getting some proper perspective on life. Because almost every mistake people make when planning for retirement starts with forgetting the timeline they're actually going to be working with. They often think about retirement like it's a 5-year chapter in life, not a 30, 40, or even 50-year journey. They often look just at today's interest rate, today's cash yields, and today's stock market prices, and they assume that's what they're going to be working with over the next 2, 3, or 4 decades. But the truth is that those numbers shift dramatically over time. Now, I once worked with somebody who retired at 55. They had what looked like much more than enough, millions in cash, carefully sitting aside in fixed-term deposit accounts that felt really safe and secure to them. But by the time they hit 70, they were in big trouble. Prices had more than doubled. The yields had absolutely collapsed. And suddenly, the lifestyle that they'd become accustomed to and could comfortably afford was slipping out of reach. Because retirement isn't a snapshot. It's a moving target. If you're spending $10,000 a month today, with just 3% annual inflation, that same lifestyle cost could be $18,000 in 20 years' time. And inflation rates recently have been much higher. So, if you're planning based upon today's figures, you're setting yourself up to be caught off guard much later. You've got to base your entire life strategy on your entire retirement horizon, not just this year's rates or this week's headlines. So always run multi-decade projections that cover you up to the age of 100. Factor in inflation and stress test your entire asset allocation in detail. Don't just throw a 5% interest figure into a spreadsheet and assume that that's going to hold true for decades to come. And before we go any further, if you want to see exactly how the wealthiest 1% structure their own portfolios for retirement, we put together a free one-pager called How the Wealthiest 1% Invest. It breaks down the same principles that we use with lots of high net worth families, so you can apply the same thinking to your own plan. There's a link in the description. Grab it now and follow along as we go through the rest of these lessons. Now, once you really understand just how long retirement lasts, the next big trap is this, and that is the 5% illusion. Cash yields can feel attractive right now. A savings account or a money market fund offering 5% or even 6%, and it can feel like a win, a real reward for just staying safe. But here's what many people get wrong. They treat that 5% like it's permanent, as if the bank has promised to pay that for the next 30 years. In reality, that yield is likely to be fleeting, and it moves. It depends on short-term interest rate cycles, central bank policies, global macro conditions, things that no one can predict consistently. And historically, there's very little correlation between today's yield and what you're actually going to get over the long term. I've met many investors who've moved millions into so-called high-yield cash accounts thinking that they're going to ride out the next storm until they can see the next opportunity. But when that yield dropped 6 months later, they were left scrambling, trying to re-enter the market that had already moved higher. And that's because risk and return are always interrelated. Higher risk, by putting your money into short-term volatility in the stock markets, will always create a higher expected return. So you need to build your future plan across average returns, not just the current ones. Assume that rates will fall again and design your future life strategy and your investment portfolio to survive just that. And that means building in flexibility, stress testing some of your assumptions, and not betting your future and your future purchasing power and life experiences on a short-term interest rate that could disappear next quarter. And even if, hypothetically, cash stayed at 5% forever, then there's another force that makes it a loser's game over time, and that is inflation. Inflation is the silent wealth killer. And here's what many high earners get wrong. They assume their income protects them, that $500,000 today will still feel like $500,000 tomorrow. But it doesn't. Over the decades, even a moderate inflation rate erodes your future purchasing power in a way that catches many people off guard. And one way to see inflation's impact is called the Rule of 72, which shows how long it's going to take your money to halve in value. Take 72 and divide it by the inflation rate. So for example, 3% inflation, your money halves in 24 years. At 4% inflation, it halves in just 18. That $15,000 monthly retirement budget, well, you might need $30,000 or more in your later years just to maintain your same standard of living. Inflation doesn't make headlines most weeks, but it's always working there in the background, and in particular on the basket of goods and services that wealthy and successful people like you are likely to be buying. It's relentless. And every day it's compounding against you. And cash, even at decent rates, just can't keep up. So you need to forecast your retirement spending in future prices and not today's. If you think you're going to need $10,000 a month in retirement, plan for $18,000 or $20,000 by the end of your retirement. That's the kind of reality you need for your future plan and life strategy to actually work out in reality. Some people think that they can sidestep all of this by sitting in cash until the market crashes. They want to wait for the perfect entry point. But here's the truth. Statistically, this doesn't work at all. They tell themselves they're going to jump in when things drop 10 or 20%. But if and when that drop actually comes, emotion and fear take over. They typically freeze and always say things such as, "This time it's different." They typically miss the rebound entirely. JP Morgan actually did a study on this. Missing just the 10 best days within the stock market over a 20-year period cuts your returns by more than half. And those best days, well, they almost always follow the worst. So time, patience, and discipline always win. So if you're sitting in cash waiting for absolute perfect clarity, you're going to likely miss out on the recovery when it does happen. The longer that you stay on the sidelines, the much harder it becomes to ever catch up with those that haven't. Inflation keeps ticking up, whilst your cash just stands still. At some point in life, all of us need to commit to a disciplined investing approach. That could mean investing lump sums immediately or just phasing them in monthly or quarterly, called dollar cost averaging. But stop waiting for the perfect moment, because it doesn't really exist. And history proves it time and time again. So if cash isn't the answer and market timing doesn't typically work, what should your retirement portfolio and future actually look like? Well, many people get this wrong too. They typically treat cash as very safe and bonds or equities as risky. But over longer time periods, the data tells us a very different story. We only need to look at the last 30-year return data to see this. Cash has actually lost its future purchasing power 37% of the time. Domestic stocks, just 13%. Market volatility doesn't mean permanent capital loss. It just means short-term market movement. But when that movement is paired with time, it actually becomes growth. Bonds, or fixed income, provides stability to this. They've historically also outpaced inflation. Equities add long-term growth, the kind that you need to build your future purchasing power and protect your lifestyle over the decades to come. Together, bonds and equities build the foundation for real retirement security. So here's a rule that you could follow. Hold enough cash for 1 to 2 years of spending. That's the part of your buffer or war chest, along with some short-dated bonds for anything up to 5 years of spending. This gets you through periods of market volatility. But the rest, that's your family fortress, and it belongs in equities, or the great companies of the world that you and I use every single day. Assets built for decades, not for months. And this brings us to the real point of all of this, and that's your future lifestyle. Because retirement planning isn't just about protecting your current account bank balance. It's about preserving and protecting your future lifestyle choices. Many people think not losing money in the short term equates to safety. But if the cost of living rises from $15,000 a month to $25,000 a month over time, and your portfolio, your assets haven't kept pace, you're actually losing your future purchasing power, even if your bank balance looks stable on paper. And this is where growth assets come from. Stocks and property. These are what maintain your future spending power. They're not just nice to have, they're actually essential. And this is why high-level wealth demands high-level thinking. The strategies that work for retail investors, heavy on cash, short-term focus, they completely fall apart when stretched across 20 or 30 years, especially for multi-million-dollar portfolios. Tiny little differences will make a profound difference to your future wealth. And often people just can't believe it when they actually see the evidence down in the cash flow. So always build your plan around sensible decisions and choices, not just around security and account balances. Use growth assets to power your long-term wealth. Use cash only for short-term spending. Adopt institutional thinking. Diversify your assets beyond cash and use that bucketing approach with cash, with bonds, with property and equities. Focus on growing your future purchasing power, and then stress test your plan not against next year, but against the next decades to come. And if you want to take this further, we're offering a professional, personalized retirement strategy session. It's where we stress test your numbers, map out your next steps, and show you exactly how to move from retail thinking to institutional level thinking and a professional plan that protects your lifestyle decades from now. The link to book this is in the description below. So if you want to get a sage perspective, crystal clear clarity, and protect your lifestyle over the next 20 or the next 30 years, you need a plan or life strategy built around growth and your future purchasing power, not just around current safety and stability. And that's exactly what the wealthiest 1% already deeply understand. In this video next, I'll show you exactly how they save and invest for retirement, the exact frameworks that they use to protect multi-million-dollar lifestyles from inflation and market swings. Click here to watch that now.